I don't think that there's anything that Trump can do during his presidency that will derail the gold thesis. I would caution people that the gold thesis is a long-term thesis, and the idea that people judge gold or judge their gold portfolio in 4-week or 5-week or 6 weeks sequences is silly. I read comments all the time that says, when is gold going to move? To which my answer is, let me think. I think gold's going to move in the year 2000. Since 2000, gold has moved from $253 an ounce to a high of 27 something, currently around 26. What is that, a sevenfold return? Gold has done 8 and change compounded annually for 24 years, and some moron says, when is gold going to move? It always fails.
The gold market has ended a 3-week sell-off with a vengeance, as prices look set to close Friday above $2,700 an ounce. Not only has gold surpassed last week's losses, but the precious metal has also experienced its best rally since October 2023. Since 2010, gold has gained value 9 times and lost value 6 times. Before this year, its 3 biggest years of growth were 2010, 2020, and 2019, in which it gained 29.71%, 25.14%, and 18.3% respectively. Seasoned analyst and trader RickRule predicts gold will trend upward with higher lows and highs over time despite short-term volatility. According to him, long-term focus is key to capturing gold's larger gains. In his assessment, Rick explains that the U.S. has historically addressed unsustainable debt through inflation, as seen in the 1970s when the dollar's purchasing power fell by 75%. This devaluation coincided with gold prices rising from $35 to $850. He suggests a similar strategy unfold today, benefiting gold investors. Over in the United States, the Congressional Budget Office forecasts that the U.S. debt-to-GDP ratio will exceed 150% by 2034, from 98% at present. Put another way, that will slingshot the nation's debt to the highest levels in U.S. history. Conclusive evidence shows that when the U.S. national debt ballooned from $5 trillion to $35 trillion, gold prices rose by 10 times since 2000. That's a whopping gain of over 826% since the beginning of the century. If history repeats itself, gold prices could reach $5,000 an ounce when U.S. debt hits the $70 trillion mark. Concurrently, Rick anticipates that inflation is the most feasible way to manage current debt. He emphasizes gold's strong performance during the 1970s inflation despite short-term corrections. However, the Fed's decision to reduce interest rates in the second half of 2024 has now resulted in a banner year for the precious metal. Gold is up by 37% over the past year, so the delayed gains from elevated interest rates are starting to show up. Now we present the clips of RickRule's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
This debt is unsustainable, and dealing with the debt is politically unfeasible. Now, we dealt with this as a people before, although the problem was less severe. In the decade of the 1970s, politically, we couldn't raise taxes, but we had to pay for deficits, and we had to account for the debt brought up in the war in Vietnam, which of course we lost, and the war on poverty, which of course we lost. In the decade of the 70s, according to the US government, through inflation, we reduced the purchasing power of the US dollar by 75% over 10 years. Not coincidentally, the gold price went from $35 to $850. The only way that we can service the nominal debt that we have as a people, particularly our entitlements obligation, is to inflate away the net present value of the obligation while leaving the nominal value intact. An old geezer named RickRule, 71 years old. I don't know what Social Security pays me, but let's say it's $4,000. You know, I was a high-income taxpayer. 10 years from now, they'll still pay me that nominal amount. They won't reduce it, although they can't afford to pay it. What they will do is they will inflate away the net present value of that nominal account. So my $4,000 will buy me $600 or $700, maybe $1,000 worth of goods and services. That's how you deal with that sort of thing. You either default honestly, you say to the bondholders and you say to the entitlement holders, too bad. You default gradually by inflating away the net present value of the purchasing power. My suspicion is past is prologue, and we take door B, which is very good for gold. Gold in 2024, who knows? Gold in 2025, who knows? Look over 10 years. If you look back to the decade of the 70s, it'll tell you something about their trajectory. 1970 to 1972, gold went from being controlled to decontrolled, so it was $35 to $100. 74, gold went on a tear from $100 to $200, doubled. 1975, the Fed raised the interest rates. Gold fell from 200 to 100. End of 1975, the Fed lost their nerve politically, cut the interest rates. And that set off a romp at the end of 1975 that saw gold go to $850. Past in this case is prologue. Gold will go up and down, higher bottoms, higher tops. People who don't understand the process will be shaken out when gold softens up. By the way, the price decline from $2,700 to $2,600, that's a rounding error. It's truly, truly a rounding error. 1975, the gold price fell from $200 to $100. That's a fall. People who got shaken out in 1975 missed a 5-year run from a $100 bottom to an $850 top.
Based on fundamentals, RickRule mentions the speculative nature of silver markets, cautioning against chasing short-term gains without grasping fundamentals. Minor silver price increases can drive disproportionate investment, inflating valuations without real value change. Reflecting on past market cycles, Rule notes that when sellers are exhausted, prices can soar with minimal buying pressure, highlighting the recent example of a 300% sector gain within months. Silver's path of least resistance remains higher at over $31 per ounce in November 2024, and we could see a challenge of the 2011 and 1980 highs over the coming months and years. Moreover, the dollar's role as the world's reserve currency has declined over the past years, which is a bullish factor for gold and silver, the world's oldest hard currencies. According to RickRule, aligning short-term tactics with long-term strategies is crucial. RickRule underscores that he ensures with gold, holds US dollars for liquidity, and currently invests, citing limited opportunities. Let's get back to the interview.
If you think the silver price is going to go up, you should buy silver. Understand all of the profligacy that I accuse governments of. Issuing phony currency, the Canadian dealer market is much more efficient. They will issue phony share certificates faster than the government can issue dollars. You talked about the correlation between a tiny increase in the silver price and the fact that a silver mining company went out to raise $8 million and came back with 50. That's called inflation. The underlying value of the silver company went up by 0.7 of nothing, and the offering went from 7 million to 50. These guys can dilute their equity even faster than the government can issue phony dollars. And you always need to pay attention to that. There is a huge dichotomy between the way people invest and speculate based on narrative and the way they trade. The strategy is long-term, the tactic is short-term. The implications of that are that a short-term tactic in pursuit of a long-term strategy, the audience got an erection about an increase in the silver price over $32. Needs to give their head a shake. When you go into a silver bull market, you won't be concerned about dollar moves or $1.50 moves. And you won't need some old crank named RickRule to tell you when you have a silver market, and by the way, it's when, the market will be absolutely positively dramatic. And if you aren't prepared for it, the best part of the move, you'll lose. When I look back to my recent silver junior trade, I had no idea where the silver price was going to go. I just knew that you had a sector that was extraordinarily volatile, that had no sellers left. The predominance of questions that were asked of me were despondent about the silver market. All of the social media discussion was despondent about the silver market. High quality silver issuers, juniors, weren't getting funded, which is to say the momentum was terrible. Well, of course the price is going to go up. If all the sellers have been exhausted, it doesn't take much of a buyer to drive the price. Now, 9 months later, the prices are up 300%. Guys go tell the same story at Beaver Creek that they told last year, and as opposed to taking 7, they're offered 60. Doug described the US dollar as an IOU nothing. He described the euro, which has what, 15, 16 countries, as a who owes you nothing. And I would suggest that the BRICS, a bunch of countries with inconvertible currencies who don't like or trust each other, is a nobody owes you anything. So in that league, the US dollar is pretty strong. I save and insure in gold. I maintain my liquidity in US dollars. And I invest in companies. That's sort of how I look at it. I have a lot of US dollars right now because I have more liquidity than I would like to have, which is really a consequence of the fact that I'm like Buffett, sadly to a different degree.
During the stagflation of the 1970s, gold prices rose at an average annualized rate of over 30% over the course of the decade. That's phenomenal growth by any measure. But could it happen again? Do you believe gold and silver will maintain their historical role as safe haven assets in the face of rising global debt and inflation? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.